Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He was a money manager for over 20 years, including co-founder of a multi-billion-dollar hedge fund. He is the founder, editor, and publisher of the Felder Report, Super Investors, The Art of the Worldly Wisdom podcast. Jesse Felder, thank you for joining me again.
Glad to be back with you, Jason.
So, Jesse, a lot of craziness going on right now. We're recording this interview on Wednesday, January 11th, 2023, for our listeners out there. What do you think are the biggest risks to the global economy right now? Is it governments and central banks, all this craziness? Just want to get your thoughts on someone that's been through a lot of different markets.
Yeah, the biggest risk to economies, I think it's clear we're in a slowdown, although you don't really see it from any of the, concurrent or even lagging kind of economic indicators. It looks like GDP now from the Atlanta Fed is saying that fourth quarter GDP is, looks pretty good, but all the leading indicators tell a totally different story. So housing is one of the most important leading indicators you can look at. And, I think was it Pulte or KB Homes? I can't remember. It came out after the close today and said that they're seeing like a cancellation rate on their new orders of up over 60%. And, you just see what mortgage rates have done, and, demand for housing has dropped off a cliff. And so, that's a pretty strong leading indicator. You just look at the Conference Board's leading economic index. It's also been, declining for more than 6 months straight. The 6-month rate of change is essentially what you'd expect to see in the onset of recession. One of the main things I look at, though, is just I put together a composite of the dollar, interest rates, and oil prices. And when those three things go up a lot, it's really bad for corporate earnings for the next year or two in advance, and vice versa. So if you have all those costs come down, oil prices, interest rates, and the dollar, that sets the stage for a really good boom in corporate earnings. And we've really kind of seen, the opposite since the pandemic lows in 2020. Over the past 2 years, dollar's been really strong until the last couple of months. Oil prices have gone from zero or negative, during the pandemic to, soaring higher. And interest rates, obviously, right? I mean, we've had 50 basis points on the 10-year. We were over 4% not too long ago. So those three things are very bearish for corporate earnings, for the economy generally. And but they take time to play out, right? They operate with a significant lag. And so I think we're kind of in that interim period where those things have been clearly very bearish, but we're only seeing the beginnings of their effects on economic activity and corporate earnings, especially.
So based on your experience, how long does it take for these interest rate hikes to start getting pricing into asset markets and the real economy with corporate debt, junk bonds, corporate refinancing, things like that? Is it 6 months, 12 months, 18 months? How big of a lag is there?
Yeah, I would say it's 1 to 2 years. You could just split the difference and go, 18 months. If you were to, I use a, kind of a 2-year forward on those, on that indicator I was talking about with, interest rates and oil prices. And so that suggests that economic activity and corporate earnings should bottom around towards the end of this year, maybe third, fourth quarter. So, I don't think that stock market has started to discount these things. I mean, Fed policy, you mentioned too, I'm talking 10-year treasuries is kind of the input into my model because that's more important to, 5 years, probably more important to corporate, finance, and 10-year closer to, more like mortgage finance and those types of things. But yeah, it takes time. And I think what a lot of people don't necessarily appreciate is the stock market has never really bottomed before the Fed has finished tightening. Typically, what you see is the Fed starts easing and the stock market still doesn't bottom for another 6 months or so after the Fed has started easing. And so we haven't even gotten close to that, right? The Fed says they're going to raise probably at the next 2 meetings to take the Fed fund rates to 5%. And so we're still in this tightening phase. And so to expect the economy to bottom, and the stock market to bottom well before the Fed has even finished tightening is I think too optimistic.
So you mentioned order cancellations for the home builders. Did we see a lot of this in 2006 and 7, or are we on a whole nother scale now with interest rates rapidly rising?
The thing about this cycle is it's really, I mean, unlike anything we've seen before because it's been so rapid, right? The Fed dropped interest rates to zero and printed $5 or $6 trillion of new money in a very short period of time. And, so they essentially floored the accelerator and now they're trying to like stand on the brake. And so it's this, monetary whiplash has been essentially compressed into a very short period of time. Back in the 2000s, Alan Greenspan dropped interest rates to 1%, held them there for a long time until I think it was 2004-05, and it was pretty clear that he had to start raising them. So they raised, and they, started easing in early 2008. But that's probably a good example for They started easing, and it did nothing to help the economy or the markets for a significant amount of time. Now, I don't think we're going to see another, replay of the financial crisis where the systemic risks, to the financial system are, huge. I think there's, a clear and well-supported consensus that the banks are in better shape right now and don't have the same kind of risk that they had. Still, we're going to enter a recession, and that the playbook from the past two, at least, if not further back, would suggest that we're going to see some the Fed has to pivot well before you can expect it to start helping the economy and the stock market.
You think that all the banks are in better shape than in 2007 and 8? Because I would argue that the European banks, especially Credit Suisse and some of the others, they're not in as good a shape considering all the problems that have been in the European economy with the energy prices, the manufacturers having problems, and Credit Suisse's stock price lately the last 6 months.
Sure. Yeah. No, I was talking about the U.S. Banking system, right? With the amount of capital they're required to hold, and the all of the restrictions on the activities they're allowed to engage in have made the banking system. Now, there's of course the shadow banking system, which is a totally different story, and you can look at all of these non-bank entities which have gotten into lending. And there could certainly be problems there, and some very smart people have suggested with private markets there could be problems as well, where we start to see investors ask for their money back. Investors are told they can't have it back, and because they need to get their money out of private equity, venture capital, these types of things, private REITs, they're forced to liquidate what they can, and that's equities and corporate bonds and things that are traded on the exchange.
So I want to, since you've been through different cycles, you've been a successful professional money manager at a hedge fund for a long time in the past, how to properly manage risks in this type of environment? How would a money manager properly manage risk in this type of environment? Are you have less long positions? Do you have more cash? Do you have stop losses? Are you playing more defense than you would have in the past? What types of measures are you looking at to try to deal with it? Because it seems there's just so many complexities going on right now, with lots of inflation, but also potential bankruptcies with companies with higher interest rates. I think we're going to see real estate crash maybe here in the US. In other countries, we're already seeing that. And then we could see, if interest rates continue to rise, junk bond defaults, corporate bond problems with a lot of private sector companies.
I mean, how to manage risk is a great question. I can tell you what I've done, but the problem is there's so many things that haven't worked very well. Right. I mean, traditionally, the number one go-to diversification risk management tool for investors has been, have a significant allocation to longer term bonds. And so when your stocks sell off, usually interest rates come down and the, bond prices go up, and that helps offset losses in the riskier side of your portfolio. That obviously didn't work at all last year, where, long-term bonds did worse than stocks, which did pretty, poorly themselves. And so, I do think that is probably going to work better going forward, that, if we are going into recession, and I think we probably are, interest rates have room to come back down again and act as a diversifier. So, that there's huge, the other side of this that I look at is speculative positions in the futures market traders are like off the chart net short bonds right now, expecting rates to just, surge to new highs. And if we're going to recession, that's probably not going to happen. I think you probably, from a tactical standpoint, can own some bonds here as you're heading into recession. But the other thing that hasn't worked is buying put options, right? The VIX has remained relatively tame. And so option prices have remained, relatively tame, and you haven't gotten paid out on like tail hedges the way you would normally expect. And so, that's another problem. And you really need a VIX spike, and I mean, signs of fear for those types of put options to work. What I've done, and this is just what I've kind of done throughout my career, is, and it's really a lost art, is just practice short selling. I think that, there are things I want to own in this market. I don't want to get out completely and not own any things. I mean, I've been very bullish on energy and commodities and things for the past couple of years, and I still think those have plenty of room to run. And so, but to I guess hedge against market risk, I'm going to sell short things. And there was a wonderful opportunity in 2021 and last year to short a lot of these non-profitable tech stocks. But even for for people that don't want to sell short stocks individually, and I really don't think anybody should try and sell short, who doesn't have experience and also very disciplined risk management, because you have to use stops on short selling, just because the risks, you're putting yourself at a lot of risk of loss when you're wrong. Markets rally. But, I've just been, short NASDAQ 100 has worked really well, too, at times over the past year. And I'm still short NASDAQ versus things that I like on the long side.
Aren't also normal defensive measures, at least in past cycles, they're cash or mostly US dollars, gold, exposure to gold, increasing exposure to gold, and then also US Treasury. So those are normal defensive measures, at least historically in past cycles, although you said buying and holding treasuries while the Fed was hiking rates, it was not working.
Yeah, it hasn't worked. It didn't work last year. But Warren Buffett used to, if he thought we were going into recession, he has always had, significant cash position. And you mentioned that. And yes, that makes a lot of sense. I think for the average investor, that makes the most sense, is to have cash, especially when you can get paid 4% plus on it today in short-term treasuries. That makes a great deal of sense. But what Warren Buffett used to do, or has historically done throughout his career, is take a significant portion of cash, if it looks like we're heading into recession, and put it into long-term zero coupon bonds, which is essentially a big bet on interest rates falling at the long end. And that's because that's what usually happens in recession. So, that's more of kind of a tactical thing that I think will work better this year, and it already has. The 10 years already fallen, to 3.5. And I think there's, if you look at things like the copper to gold ratio, it suggests that rate could fall as low as 2.5 if we go into recession. And so there's room for more rally in the longer end of the yield curve. But you're right. I think, cash reserves probably the smartest and easiest way for the average investor to be conservative in this type of environment.
Well, the gold price is also starting to finally respond and act, I would say, as a safe haven because of not a big spike in the VIX, but asset price volatility with bonds. And people are seeing all the headlines about problems with central banks. I mean, the newest headline that we just had in the last 24 hours is the Swiss National Bank had turned itself into a hedge fund over the last decade and has over $100 billion in losses on its stock portfolio.
Yeah. And if you look at, central banks around the world, they've been buying more gold than any time in history. I think, Bank of China said they bought 60
I doubt they're honest. Well, they released a public document saying they increased their gold holding, but I doubt that that's honest.
Yeah, I mean, they're actually, I would think they're probably buying more than they're saying, because the demand from, I mean, we know how much money, how much central banks are buying. We don't know specifically which banks, but you can guess it's China and Russia. And after, the sanctions imposed on Russia after invasion of Ukraine, you can see why, Bank of China would say, hey, we don't want to have a ton of treasuries and then do something the US government doesn't like, and then they limit our ability to sell or use those funds. I think also, China is offering, their people have done, a lot deeper work on this than I have, but Bank of China is offering to trade commodities in yuan and back the yuan with gold, and that would be a very enticing thing for commodity sellers to say, yeah, we'll take yuan instead of dollars. If we can exchange it into gold, there's really not much risk, and so that could be a reason why China's acquiring tons of gold also, is to be able to offer that as a way of making sure that their supplies of commodities are secure. I think, generally for me, the case for precious metals is getting more and more bullish. I mean, obviously the price has rallied nicely from under 1,700 a month or so ago, a couple months ago, to almost 1,900 now. The CPI report will probably throw some volatility into that mix. But I think that the bullish case for precious metals is only growing stronger, as we move into this year. The Fed is really trying to, its best to play Paul Volcker, but with the amount of debt that the U.S. has at the federal level, 120% debt to GDP, versus 30% during Paul Volcker's time. If they're forced into, having to tighten even further, we're going to get into a situation where they're going to have to choose between fighting inflation or making sure the Treasury is solvent. And that is a pretty scary potential outcome. And you hear people like former Treasury Secretary, former head of the New York Fed, Bill Dudley. They're talking, when these guys are talking about this stuff, it means that this isn't just conspiracy theory stuff. This is a real potential outcome, and so I think that, yes, having a significant allocation to precious metals makes a lot of sense in the current environment.
Well, also to add to your points there, when I see all these headlines and problems in the European Union, the United Kingdom, Japan, emerging markets, doesn't make me want to go buy a bunch of long stocks. I see government debt crises all over the globe. I mean, look at Japan. It looks like finally, after 30 years, and you were in the hedge fund community, I'm sure you had lots of friends, hedge fund managers. It was called the Widowmaker trade, who were trying to short the yen, who were trying to short Japanese government bonds way too early. Finally, looks like Japan's hitting the wall with their math problem. And I don't think the US is that far behind Japan with all the government debt problems that it's having, where either the central bank has a choice to make. Either they defend the government bond market, like you said, or they let the currency just devalue rapidly against another currency or against other commodities like gold.
Well, I think that's part of the bull case for gold is, and that's probably where we're headed, is the Fed is not going to be able to be as hawkish as they might need to be. Inflation's going to come down this year. Just the year-over-year comparisons are, getting real tough this year, obviously. And also there, with the economy slowing and all these things and goods prices coming in, inflation is going to slow this year, and it's going to look like the Fed has done a good job in bringing it down. But the Fed has never finished a tightening cycle with negative real Fed funds rate. Say they get the Fed funds to 5 and inflation still comes down to 6. We're still over 7 right now, according to the November report, the last one. We'll see what December comes in at tomorrow. But if they have to take rates higher, and I really think they do. What Jay Powell should really hope for is, let's be really hawkish, really quick, Let's slam inflation and slam interest rates back down, because that's the best thing for the Treasury in the long term, right? We just can't afford, 4, 5, 6% interest rates for any length of time. That's just, when the government has to refinance at those higher rates, it's problematic. Just like, you look at credit cycles for corporate bonds. When you have these periods of higher interest rates, when corporations have to go refinance at rates that are twice what they, the last financing round was at, that's when you see a lot of defaults and a bad credit cycle. Now, obviously, the Fed doesn't, is not going to default, but they might be in a position where the Fed has to print money to help prevent interest rates from, it's yield curve control. I think we're probably going to see yield curve control at some point.
Oh, I agree. It's basic math, Jesse, because at 6% interest rates, if the U.S. Treasury is refinancing many trillions at 6%, the math just doesn't work.
Right. Interest starts to eat up, too much of the budget. And I think we're really close to this. And like I said, you and I, it's not just you and I. This is Bill Dudley wrote a piece for Bloomberg last week, former head of the New York Fed, saying he would be surprised if we didn't see some type of fiscal issues this year and undue volatility in the Treasury market as a result. And so, that's why the Fed really, really needs to slam the brakes on the economy, get interest rates back down, because they can't afford to get this wrong. It would be a much, much bigger problem than anything Paul Volcker faced, half a century ago.
But the Fed doesn't have a good track record of soft landings and being accurate with their policy decisions. They tend to do things reactionary and make a lot of problems worse. I mean, they create artificial boom and bust cycles. I'm an Austrian school economist at heart. So they create tons of boom and bust cycles and asset bubbles. And then the U.S. Treasury takes in all these capital gains tax revenues on stocks, bonds, real estate. That's the post-2008 world that we lived in. The other major problem I see, Jesse, is, and you mentioned this, that they're going to have to buy the U.S. Treasury debt. I don't see the same foreign buyers lining up. So in the past, a lot of our budget deficits at the federal level were financed by China, Japan, Germany, these large countries running trade surpluses and then recycling those trade surpluses or foreign exchange reserves back into U.S. Treasuries. I don't see the demand from these large foreign entities to go and buy massive amounts of U.S. Treasuries.
Yeah, I'm glad you mentioned the fiscal deficit, because, right, I mean, we've had a booming economy, right? Nominal GDP in double digits, as part of this recovery coming out of COVID, and still the deficit is 5% of GDP. That's like one of the worst, readings in history. I mean, during an economic boom, to see a 5% deficit to GDP is really problematic. And you think about, okay, if we are going into recession, does it go back to 10, 15% again, like it did? We hit 15, I think maybe 18 or something, during the pandemic, when the economy went into recession and the government had to, engage in a bunch of fiscal stimulus. But I think it's probably we go back to 10% on the deficit. These types of things are totally, to have debt to GDP at 120 and deficits of 5% during an economic boom and 10% during recession. These are all unsustainable numbers. And so how do you get out of it? Well, you either have to rein in spending at the federal level a great deal, which only, like we learned through in the wake of the great financial crisis, fiscal austerity is really problematic, right? It creates if you want stagflation, go ahead and put the brakes on fiscal spending, and you get the slow nominal growth. But inflation is probably going to remain high for other reasons, in terms of, like the reshoring of labor and deglobalization and all these things, these other trends that we're seeing. So the way you fix it is you slow spending, or you raise taxes a bunch. That's what modern monetary theory says. How do you rein in inflation once you've printed a bunch of money? Well, you have to raise taxes. Well, good luck getting that past Congress. I think we probably are going to see taxes, raised on corporates. I think they're going to have to do that sometime in the next couple of years, undo the Trump corporate tax cuts. Now, that would be very bearish for corporate earnings, but it's probably the most palatable thing the government can do, is just undo those tax cuts from, 4 or 5 years ago. But they're not going to raise taxes a great deal, especially going into recession, and they're not going to rein in spending. So we're in this situation where the fiscal side is pretty much set in stone, and the Fed is just going to be forced to basically make sure that the Treasury remains solvent and make sure that it can fund itself reasonably at reasonable interest rates. And that means the Fed's going to have to come back into the market again at some point.
And the Fed's balance sheet is going to have to expand. So instead of contracting with quantitative tightening, the Fed's balance sheet's probably looking at expanding many trillions over the next couple of years. So at some point, probably maybe by the end of this year in 2023 or early 2024, the Fed's balance sheet's going to start increasing again, because I just don't see the buyers to go and buy all of those U.S. Treasuries that the U.S. Treasury needs to sell. The other problem, Jesse, is that neither political party is discussing really spending cuts. So there's a few people here and there, like a Rand Paul or someone like that, talking about spending cuts, but he's a tiny minority in all these politicians here in the DC metro area. I've lived here for over 20 years. There's Republicans and Democrats. The only thing that they can really agree on, besides limiting a third party, is that they both want to spend more.
Yeah, well, they've both realized, I think, discovered MMT, both parties, right? I mean, the Republican Party would love to just continue cutting taxes, and the Democratic Party would love to just increase spending, by way of student loan forgiveness and all types of things. And I think there's another side to it too, is that the American people have gotten accustomed to, when we go into recession, the government better start cutting us checks, right? After the pandemic and the way we trained people to expect, okay, here's a check for $1,000 and here's another one, there's going to be the expectation of more of that. And so, it's just a really difficult situation. And I think this is why you have to own some gold in the portfolio, because if the Fed is forced to, talk out of the one side of their mouth saying we're really going to do whatever it takes to rein in inflation, but the other side of the mouth, we're going to have to undo quantitative tightening, come back into the Treasury market, just like the Bank of England was forced to do as part of the pension crisis there a few months ago. The Fed might be forced into a position where it's trying to still battle inflation and also print money at the same time, which I think pretty much everyone around the world would kind of see through that and realize that, wait, the Fed, is telling us they're trying to fight inflation, but everything they're doing is actually inflationary right now. You just look at, it was another blog post that I wrote recently. Fed funds rate is not even 5% yet. And inflation's still 7%, right? So you still have a negative real Fed funds rate. Taylor rule says the Fed said it should be closer to 10%. So to call this policy hawkish, I think is a stretch. I think they're still engaging in relatively dovish policy, and until we see a real positive real Fed funds rate, it's hard to have any confidence in the Fed's ability to rein in inflation over the longer run.
Well, the U.S. federal government is the world's largest debtor, though. So, eventually, I think the government, they don't want to do an honest default of the debt. They want to inflate away the real value of that debt and the unfunded liability. So they just don't want a bunch of people noticing. So when people see stagflation, people see high food prices, gasoline, people see the CPI, what the CPI hit, 9% or 10% at one point in 2022, people see those headlines. And then you see the Google searches that people are looking up stagflation, inflation, more people are waking up. So of course, then the Fed's going to try to do that. But for many years, Jesse, it seems like the Fed got away with asset price inflation, which is, I guess, quote unquote, the good kind of, and I'm using using air quotes here, the good kind of inflation, even though I view inflation as a tax. And Keynes said that inflation is the stealth tax that barely anyone could recognize. But now you've had the reverse where asset prices are deflating, not the traditional with the money supply, but the air is coming out of the balloon and asset prices are volatile and falling. And now you have consumer prices that are at record levels compared to the past.
Yeah, there was a great editorial in the Financial Times this week from former central banker from India, and he made the point, and I think this is a really good one, that the Fed told us, over the past couple of years before it, pivoted again towards inflation fighting, that we're going to tolerate a higher rate of inflation. That essentially, we're not targeting 2% anymore. We're going to try and look for a 2% average. And that's a very clear communication from the central bank that we want inflation higher than it is, higher than it has been for the past decade. So, it really shouldn't be surprising to Jay Powell or anybody else at the Fed that they're having a hard time right now convincing the markets that they're going to, be as hawkish over the next 12 to 24 months as the dot plot, or as they're telling us, that the market expects them to pivot and start cutting rates before the end of this year, and that is in line with what they told us, was their new inflation mandate, which is we wanted to average 2% over time, and make a very clear point of, it's 2% isn't a hurdle. And it never was. We want it above 2. And so you're right to point out that the U.S. government, the Fed, and the Treasury wants a higher rate of inflation, needs a higher rate of inflation, because inflating away the debt is really the only way to get out of this, is something that I think all investors need to recognize, that we are in a new, this is a sea change in markets. What we've seen over the last 10 years of ultra low interest rates and money printing to support asset markets, that era is over. We're in a new era now. And it's been, if don't fight the Fed over the last, 10, 12 years was buy stocks, don't fight the Fed now means you need to position for inflation, because the Fed wants it. They're going to pretend like they're Paul Volcker and they're going to, break the back of inflation, but they really don't want to bring it back all the way back down. They want to bring it lower than it is, but I think they'll be happy with 3 or 4, which is still, significantly elevated compared to what investors have come to expect in recent years.
And this is the Japan playbook. So the Bank of Japan, Japanification, yield curve control, they wanted the real inflation rate above the interest rates that the government is paying on the debt. They wanted to inflate their debt away, and they wanted to manage their currency so they didn't have currency problems. They got away with it for so long. I mean, way longer, many, many years longer than a lot of people thought. But it seems that they're finally hitting their limits now. And I think at some point, the U.S. is for sure going to hit its limits too with math as well, because copying Japan, throughout financial history, it just doesn't work. And Japan was able to get away with it longer than any other country in financial history.
Yeah, and there's a major difference too, I think, in terms of people point to demographics as a disinflationary force. And there was a great book, I think maybe we've talked about it the last time I was on, but The Great Demographic Reversal points out these demographic forces of inflation are really starting to exert themselves on the U.S. economy. So aging in the U.S. is inflationary, where it really hasn't been in Japan. And the difference is, as people age in the U.S., they retire and they go out of the workforce. A lot of people in Japan just keep working. You have an elderly population that is, that continues to work, and so really it's this dependency ratio that you want to look at, the amount of people working versus not working. And the Fed has been really focused on this recently too. How many people left the labor force? How many people retired during the pandemic? Because that's, when you have fewer people working to support a larger overall population, that puts a lot of pressure on wages to go up, which is what we're seeing. So Goodhart and Proudhon's book, I think, was really a revelation to me when I read it a year ago. And it's the demographic force for inflation is already there. And so the Fed would probably have to be more, tighter than they otherwise would be going into this. The BIS wrote about it actually 3 or 4 years ago also. And so this isn't an issue that people should be unaware of, and especially central bankers. They know that this shrinking workforce means a higher wage growth over a longer period of time. And so, the forces for inflation, it's monetary policy, it's demographics. I briefly mentioned deglobalization and this, reshoring of supply chains and things. All these things are inflationary, and they're all working together right now over a longer period of time to create a totally different environment than investors are used to.
The other higher force for inflation and higher cost of goods sold and more shrinkflation at the grocery store, the restaurant, or the consumer goods items that someone buys off Amazon or Walmart or Target is energy prices. So energy and electricity. So I don't think the consumer price index or the producer price index is accurately accounting for higher cost of goods sold with all these energy price increases in a lot of countries, whether it's diesel prices, electricity prices, oil, all these prices over the last 2.5 years, they're up. Yeah, we've had natural gas. Natural gas futures here in the US got absolutely whacked in the last couple of months. I think it's down around 50%. And now natural gas prices are below the cost of production for some of the mid-tier range, mid-tier cost quartile natural gas producers. But that's not sustainable. So I think we're looking at an environment where there's a lack of investment and supply side investment and all these bad policies that are with ESG that are blocking oil and natural gas drilling or pipelines or new refineries, basically preventing new supply from coming online and cheaper prices to the consumer. So I think we're looking at a higher Cuppy, hedge fund manager Cuppy from Inventors in Capitalism, Praetorian Capital. He says a higher lows, so higher cost floors for energy prices for oil and natural gas going forward.
Well, it's true for all commodities. Probably is I think there's two government policies that have gone on for a number of years now that are also inflationary. And you mentioned one, which is, we've really made it difficult for commodity companies to invest. And so they have not put any money to work for a long time. Right. The oil price crashed in 2014. And since then, there's been little to no investment in energy, in new sources of natural gas and crude oil. That results in lower supplies and higher prices. And that plays out over a long time. So people who think, energy stocks have rallied as part of the cyclical, reopening trade, it's over, don't appreciate the longer term forces at work that drive super cycles, which is basically just the capital cycle. So money has these companies have been starved of capital, so investments down, so supplies are down, so prices are up, and it's going to be like that for a long period of time. The other thing that I think people are even less aware of is our competition policy. The antitrust policy in the country for the past 30 years has gotten more and more business friendly, where we've allowed concentration across so many industries, airlines to food companies to technology. So you have this fewer and fewer companies producing the goods we need to run the economy, which is why they've had such incredible pricing power and why we've had such high inflation, because there's very little competition for a lot of these different goods and services that we need, because companies have just bought up all their competition, and the FTC has essentially allowed it for 30 or 40 years. Now there's a new administration. The Biden administration is looking into reforming antitrust policy and kind of bringing some competition back into the markets, which is a healthy thing. It's much needed to reduce this concentration and allow for more innovation, and competition is only good for prices. But it's made very little progress so far, and the fact that we have one or two companies that produce chicken and or different types of things is part of the reason why we have high prices. So you have that concentration and lack of investment in just natural resources that are also contributing to these inflationary things. These are all longer term forces that the Fed is not going to be able to impact very much.
Well, also the input costs, not only that, so you have 5 or 6 food companies like Nestle, Unilever, Tyson Foods, and a couple other foods, maybe Smithfield, and a couple other food companies own almost, I think there's a Brazilian meat company, and then the company that bought Budweiser for alcohol and beverages. So there's like 6 companies maybe that own the majority of the food brands in the grocery store and the wholesale food.
Right. Yeah, and they have almost no competition, or when they do have competition, they essentially collude because
they buy them. Yeah, they make sure that the small company can't afford to pay the grocery store fees there's documentaries about this on Netflix for premium shelf space. So they can't pay. And then they buy out the competitor for pennies on the dollar. So you have it's not a full monopoly where you have 1 or 2 companies, but it's basically like an oligopoly where they've gamed the system.
Exactly, and that's another force for inflation. That we of all these things that we've talked about, how many of these things can the Fed actually impact? And this is kind of the argument that some have made. Say, the Fed shouldn't be hammering the economy. They have to do this. We've talked about it, but it's going to have an effect on the economy, but has very little effect on these other forces. So I think while the last 20, 30 years was really the era of monetary policy, where central bankers were the stars that everybody was looking to. I really think we've already seen fiscal dominance rise in the last few years, where the Fed is no longer engaging in discretionary monetary policy. It's doing whatever the Treasury needs, and in terms of printing money when the Treasury needs it. And so it's going to be on fiscal policy to address a lot of these things, but it's going to be years before we figure out, wait a second, the Fed really has very little power here to influence longer-term inflationary forces, and it's going to have to come from the federal government making reforms in a lot of these different areas, and that's not going to happen overnight.
Yeah, I'm not holding my breath that the government's going to make any radical changes like that. They're already talking about increasing spending. They passed this ridiculous 1.7 trillion omnibus. God knows what the total number is probably going to end up being a lot higher than that. There's going to be tons of spending pork in the bill, with trading votes back and forth with each other that has nothing to do with what the bill says it's supposed to do. This is just unfortunately how the sausage is made here in DC.
Right. And when you translate what this macro picture looks like for investment portfolios, it's you want to position almost the exact opposite of the way you did over the last 10 or 15, 20 years. The 60-40 portfolio has worked so well for so long that investors think that it's the only way to invest. Well, if you go back, before the early 1980s and look at a truly long-term picture, 150 years worth of data, right? It's a totally different picture. And I think that, an environment like we're talking about, a macro environment where you have structural inflation drivers that are really outside of the Fed's control, you have to have a lot of exposure to real assets, generally things. And the stuff that you didn't want to own for the last 30, 40 years are the things you do want to own today. And that's precious metals we've talked about. It's commodities, and I think certain forms of real estate are probably going to work pretty well. You're absolutely right to note that residential and retail is not looking good right now in terms of real estate, but there are areas that may work, and I think there's probably going to be a good buying opportunity in real estate, especially over the next couple of years.
Over the next couple of years, probably not right away, though. I think actually, Jesse, commercial real estate, which a lot of these pension funds own enormous amounts of, is in especially real estate investment trusts, but pension funds have exposure to it through other maybe subsidiaries that they've created, or they've given private equity certain amounts of money to go and buy entire streets of houses in certain areas to try to make rental properties or other stuff. But I think commercial real estate, there's going to be a lot of downsizing because people are working from home more, people are buying more online. So you don't need as much retail space. You don't need the old bricks and mortar retail model where you build a bunch of stores inside these different shopping malls, and then you hope the consumer, you get spending a lot of money on marketing and hope the consumer goes and checks out your store. You can just do a bunch of ads. You can sell from your parents' basement almost, or a warehouse, and you can run a bunch of ads with influencers on Instagram, and you can kind of do it reverse, where you do an online clothing brand and you sell it online first, and then you can open up a few stores later if you want.
Sure. Yeah, absolutely. I mean, things are changing, but real estate has reinvented itself many times. And, I think in terms of residential, the thing there are two major differences between today and the housing bust from 2008, 9, 10, 11, 12. And first is the supply is very limited. And if you think about if our supply is going to come online, well, home builders are also already dramatically reducing how much new supply they're going to bring online. And people who have, a 3% mortgage are going to be really reluctant to want to sell in this environment if they have to go get a 6% mortgage on something new. So supplies are probably going to remain relatively limited. At the same time, a major difference between today and 10, 15 years ago was wage growth went in the toilet during the Great Recession. Wage growth is really still very strong today, and with that demographic discussion that we had, wages are probably going to remain relatively elevated for a period of time, which means one of the number one drivers for real estate prices, wages, is going to be pretty strong for a period of time. So I'm not nearly as bearish on residential real estate as I was in 2005-06.
Yeah, I agree. I think commercial real estate, though, is looking at a pretty big bust. I mean, just seeing some of the numbers out of Silicon Valley with the cancellations for rent there and New York City, I mean, it's looking pretty ugly.
Yeah, I mean, yeah, especially because they have been one of the number one. They were really the only during the pandemic, buyers of commercial, and I think they clearly they hired too much. I mean, all these companies are saying that during the pandemic they all saw massive demand take off because people were staying home, and so had to buy laptops, and all the demand for technology services just went through the roof for things like Zoom, like we're using right now, right? And now all the demand for that is dropping off of a cliff. And so they're all finding out, wait a second, that demand, that surge in demand is not sustainable. It was a major pull forward of demand. It's evaporating now. And so we overhired, we over leased, we overdid, basically everything. And now they're having to undo it. So yes, we're seeing a typical, cycle in terms of those things.
I want to ask about pension fund bailouts. So you spoke about the UK government problems. So the UK government and the Bank of England, actually, there was an emergency period of 3 or 4 months ago. In a 48-hour period, they were raising interest rates, they were reducing their balance sheet, the Bank of England was, and then pension funds, I guess they had on what the risk parity trades, still these leveraged bond trades, and the pension funds got in a lot of trouble. It wasn't just pension funds, it was insurance companies, reinsurance companies. Are we looking at a situation here, not Lehman Brothers in 2008, but where these pension funds are going to need bailouts, and maybe the insurance companies or whoever lent extra capital to the pension funds to go and throw on these hedge fund trades, and they're going to need bailouts then from governments or central banks?
Well, I mean, the pension problem there, was, I think you kind of touched on it, comparing it to risk parity. It was essentially leveraging up, the bond side of the portfolio. The details of that is really, above my, ability to understand it. I haven't done a ton of research on it, but I do understand that it was essentially when interest rates are really low, pension funds felt compelled to lever up in order to try and meet their hurdles. There was an interesting discussion on this topic with on Grant Williams' podcast recently with James Aiken, and he makes the point that that fiasco with the UK pension funds is really just representative of a larger trend, which is when you have 0% interest rates and you have all this super low risk-free rates, it encourages the type of leverage that you wouldn't see otherwise. And so there's a real potential for an unwinding of that leverage now, where I think investors broadly, massive institutional investors, these massive pension managers are realizing, wait a second, if I can get 4.5% on a 2-year, and I can get 3.5% on 10, I don't need to leverage up anymore. I can just buy these things and not have to take as much risk. And if that's the case, then there means there's a deleveraging on the horizon that could be bearish for, and I don't have to take as much risk. I don't have to put so much in the stock market, right? The TINA trade, that there is no alternative to owning stocks, is kind of dead also. And that's part of the reason why we've had this bear market sell-off last year is people go, wait a second, I'm not getting 0% anymore at the front end of the yield curve. I can get 4.5%. So why do I need to take so much risk in the stock market? I don't. And so I don't need to own stocks like Tesla and things. And I can be more conservative and still generate good returns. And so I would say that what happened in the pension world, the big takeaway from that is that this is what happens when leverage needs to be unwound, and this is really what the Fed is trying to do is tighten financial conditions. The way they do that is raise interest rates. It lowers the prices of risk assets. That's part, widens corporate spreads, which haven't widened near enough, I think, to their satisfaction. And that's how this plays out. But what I don't think the Fed, is totally aware of, and nobody really is, because there's no way to really quantify, but how much leverage is out there. How many of different pension funds have put on leverage in different ways, maybe not the same way the UK pension funds did, but large institutional investors, how did they leverage up? How did they take more risk? And how do they, how much of that do they need to unwind?
Do you think then that retail investors and institutional investors, because of higher interest rates and the policies these governments and central banks will be doing now and going forward, they're going to be focusing then on more quality companies on the fundamentals, focusing on profit margins, free cash flow, looking at debt on the balance sheet, was a margin of safety, trying to make sure that the company can actually survive higher interest rates or refinancing corporate debt, rather than necessarily looking at rapid growth companies that are revenue only? So the Silicon Valley model that they got away with for years, where it was they make their own accounting metrics, that's not generally accepted accounting principles, and then they just focus on revenue only growth, and they grow for growth's sake and not focus on efficiently growing with good profit margins and free cash flow.
That's what investors should be doing, right? I think investors should be rediscovering old school value investing, right? I mean, there's a reason why it, is what Warren Buffett attributes his success to, why it's lasted for so long through a variety of different markets, is because the margin of safety concept is probably one of the most valuable things an investor can learn. It's, it went out of fashion over the last 10 years, but it's what investors should do. The problem is a lot of these pension funds, CalPERS is one of the biggest in the world, and investors in a broad sense, retail investors, all adopted a passive approach to investing, where I'm just going to buy the index, and I'm going to be happy with whatever the return is. That's worked great. But what people don't, I think, appreciate is the index with the market cap weighting, skews the portfolio to the most overvalued stocks in the market, and the most undervalued stocks in the market, it dramatically underweights. And so this strategy.
So it's not rebalancing then like a professional money manager might.
No, it does the opposite. When a stock gets more overvalued, the index buys more of it. Right? It's doing the opposite of that. That's what passive investing is. The market cap goes up. So literally, you take any famous, Tesla is a good example recently. When Tesla was at its peak share price, the index had a greater allocation to Tesla than any other time. And so it poured more money into Tesla at the worst possible time. And that's just how the the index operates. It's essentially built into its DNA, and that is the exact wrong thing to do, I think, in this type of environment. When you want to own things with a margin of safety, you want to avoid things that are overvalued, and it's why you saw NASDAQ down 30% plus last year, S&P down 20%. And a lot of value investors were flat or made money. It's very reminiscent of that 2000, 2001 time period where, in the run up to the dot-com peak in March of 2000, if you didn't own these non-profitable tech stocks, you didn't make any money. But if you owned things that had a good margin of safety and were compelling from a value perspective, you actually made a lot of money in 2000, even as the NASDAQ started to crash. And value investors had it was a heyday in that 2000, 2001, 2002 bear market, because you actually made a lot of money in value, even as the NASDAQ cracked and went down 80% plus. I think we're in a very similar environment today, where if you are focused on value, the returns are there. I mean, energy's up, 50, 60% last year. Most stocks are trading 3-4 times cash flow. They're still cheap. But if you were owning the index, right, you had a 2.5% allocation to energy. Nothing. It was nothing. And it didn't help you at all. And that's just how it works. You have essentially no exposure to things that are attractive and tons of exposure to things that are unattractive. And so, yes, investors should be looking at things like margins of safety, value, cash flows, but they've all gone passive, right? More than 50% of, all the, money invested in the market is now managed passively. And so I think that's, there's going to be a shift where investors realize just what they've realized over the last few years, like ESG maybe not be this, it's maybe not the smartest way to invest money. Passive is also maybe not a great way to invest your money as well.
And you brought up Warren Buffett, not just him. I mean, he's increasing his positions in Chevron and Occidental Petroleum a lot lately, especially the more they go down, the more he buys, because he's convinced that there's long-term problems on the supply side with oil and natural gas. But you're seeing other big name investors like Stanley Druckenmiller, David Einhorn. I just saw another recent interview in the last couple of weeks with Kyle Bass, and he's been speaking about ESG and more clean energy investments. But then he just said how cheap oil and natural gas are getting those shares. So he said he started to increase those. So smarter investors are looking more at energy than I've seen in many, many years.
Yeah, and the way I came across it in fall of 2020 was, I follow corporate insiders, and the insiders at these companies were buying the shares hand over fist in October, November of 2020. Continental Resources, Harold Hamm was literally buying $50 million, $60, $70 million at a time of CLR stock before he finally took it private toward the end of last year. But that's the only area of the market. One of the only areas. Healthcare is another one where there's decent insider activity. But energy, you still have insider buying, and in virtually all these other sectors, especially tech, there's no insider buying to speak of. And that's different. I mean, in aggregate at stock market lows, I track as a blog post I put out today, I track the 12-week insider selling and buying totals across all companies. And at stock market bottoms in 2016 and 2020, we saw insider buying pick up to, $2-3 billion during that 12-week window. And there's just no buying to speak of right now, which tells me that insiders in a broad sense are not nearly as hopeful for the broad stock market as many investors, are today. Retail investors who are just still pumping tons of money into these passive ETFs over the last couple of years. To me, that's a warning sign, something to pay attention to. But the fact that there is good insider activity in some of these other stocks and sectors that are have very little interest from in a broader sense is compelling to me.
Yeah, I try to ask myself each day what's cheap and what's hated Monday through Friday. So I look what's down a lot. I mean, natural gas prices are down enormously the last couple of months. So that would interest me more than when natural gas prices were at 7 or 8 months ago. So from a contrarian standpoint, value investor, I mean, there's still electricity demand growing globally. A lot of these emerging market countries, they're adding new infrastructure. People are consuming more electricity than in the past. I think even US electricity demand was up. So if we're going to use more electric cars, we're going to consume more electricity going forward.
Absolutely. And I think that's something that, Javier Blas wrote an interesting piece for Bloomberg today, where he pointed out that even with the boom in electric vehicles, right, people buying more and more electric vehicles, demand for fossil fuels is going to hit records over the next few years, right? We're using more fossil fuel based energy and petroleum based products. He pointed out the demand for plastics is just growing like crazy. People don't realize, where does plastic come from? It comes from petroleum. The green revolution is going to be very commodity intensive, right? Maybe not. There is petroleum.
Copper,
demand,
yeah,
right?
yeah. You're going to need copper.
Copper and all these other products. If we don't invest massively in these things, the green revolution doesn't happen, or it happens and it's very, very expensive and it's very inflationary. So the way the capital cycle works is capital dries up, prices bottom, demand stays relatively stable or picks up. And because supplies are, down because the capital wasn't there, prices go to the moon. Eventually, prices go high enough to attract investment. Capital comes back into the sector. You get a bunch of investment in new supplies. Supplies overwhelm demand, and prices crash again. But we're nowhere near that yet in commodities, and we're nowhere near in oil and natural gas. We haven't seen the money come into the sector yet, and so this bull market for commodities and energy isn't going to be over until you see massive flows come in and massive investment, that can create the type of supplies that can overwhelm demand. We're a long way from that. And so I do think we're in a secular bull market for all these things.
And I think higher energy and oil prices means higher fertilizer prices, especially with natural gas prices outside the United States, and higher food prices too. So the consumer out there, higher energy prices, higher natural gas prices. Farmers have skipped planting season because natural gas prices were so high and fertilizer prices were so high. So we're going to potentially see crop failures, less supply for food, and then the farmers are going to order that fertilizer. It's probably going to be at a higher cost, and they're going to pass that on to the customer over the coming years.
Absolutely. I mean, the energy prices affect everything. They go into everything. And so to think that we can, abide by those ESG mandates and say we're just not going to drill for oil anymore, I think we're going to look back in a few years' time. We're going to look back at that mindset as insane. That was an insane.
Didn't Sri Lanka try to eliminate Sri Lanka tried to eliminate fertilizer, if I remember correctly, and they had a food shortage. So, and that helped cause their inflation spike and then the collapse in their government because the poor people in Sri Lanka couldn't afford. There was a lack of food and the cost of the food was up enormously. So their ESG policy for trying to switch to only organic fertilizer and not using the cheaper fertilizer, the fossil fuel one with natural gas, that caused an enormous backlash and it eventually collapsed their own society and their government.
Yeah, and there are, it's interesting. I mean, you see this time and time again where, there's good intentions, right, for the policies, but they're so short-sighted. They don't look at the ramifications. And that's probably a good metaphor for monetary policy too, right? Monetary policy is well-intentioned, right? I don't think central bankers want to inflict a bunch of pain on people. I really do think Jay Powell is a good person who wants to do the right thing for the country. But, and take it back to Alan Greenspan. But what they don't appreciate, and this is something I talked about with Bill White on my podcast 5 or 6 years ago, are the unintended consequences of these well-intentioned policies. It's the unintended consequences that always come back to bite us. And, we can look at, the immediate effects like, oh, hey, if we do this, and maybe it'll help the economy do this or help consumers with that. But then the longer term ramifications that are unintended are really the ones that come back to bite us. And it can be in these ESG policies and starving energy companies of capital. It can be in monetary policy that we need to help the economy in the short run. Oh, whoops, we let inflation out of the back, and that's a much bigger problem than the one we had a couple of years ago, right? It's just time and time again, and you would think that we would learn, from this that. Whenever we try and solve short-term problems, we create bigger, longer-term ones. But it's almost human nature to just kind of go through these cycles. And so, being aware of them and seeing how these things play out, you can see it time and time again, and it helps you say, okay, how do I need to position for my investments? And it's very informative, I think, in that regard.
Well, I think the myopic short-sightedness of the problems that you just highlighted have to do with how much power and control governments and central banks have. They have too much power and control. And then when they pull the policy, they make mistakes. And then they're, we could do this. We could do this. It's like pulling all these levers. It's like the Austrian school economists talking about Keynesian economics and central planning, that the Keynesians are like the Wizard of Oz behind the curtain trying to pull all these different levers, and they just make things worse and worse and worse. And now here we are, 30 decades later after bad central bank policy. I mean, it started with Greenspan, with him lowering interest rates and flooding. He didn't want a real recession. And then he did a bunch of quantitative easing, and the Fed's balance sheet, since 2008, it was at around 800 billion in 2008. And now it's a little under 9 trillion.
Yeah. Well, I mean, my friend Tom McClellan likes to point out that the Fed's legal mandate is 0% inflation. That's what's actually on the books. And so the fact that the Fed is targeting an average of 2% is essentially illegal. Congress has never given them the authority to do that. So Congress does have the power to say, wait a second, 2% no, and not an average of 2 either. Your mandate is 0.
But Congress loves spending, Jesse, and then Congress gets to trade on that inside information, and no one goes to prison.
Absolutely. And if the Fed were tasked, if Congress were to hold their feet to the fire and say, you need to make 0% inflation, right, we'd have another, great recession, if not Great Depression, because they'd have to raise rates above the inflation rate. We'd have Fed funds at 8 or 9% today, in a Paul Volcker-esque type of thing. And then you'd really see a massive crash in housing, major corporate delinquencies. I mean, it would be very, very problematic. And so, it's a problem of our own making, right? Congress is to blame, the Fed's to blame. But it's also the fact that we try and, instead of, take short-term pain for long-term benefit, we try and eliminate that short-term pain, and we have long-term costs that just continue to grow.
Yeah, I think we're going to have a lot higher inflation as the new normal, and probably higher taxes going forward for a lot of us. Well, I really enjoyed our time today, Jesse. I've kept you for over an hour. I want to thank you so much. If my listeners want to check out your newsletter or your podcast, how do they do so?
Yeah, I try and put out a blog post or a podcast, although I've been on hiatus with the podcast for a while. But on a weekly basis, I try and put out one or the other, and it's available at thefelderreport.com. I'm also, probably overactive on Twitter. It's just at Jesse Felder, and I just tweet a lot of the things I'm reading that I find interesting, charts, all that kind of stuff.
Excellent. Well, thank you again. I really enjoyed our discussion, and we'll have to have you back on again in a few months for an update.
Sounds good. Always great to chat with you, Jason. Thanks.